Hello, everybody. It's Christian Thwaites from Brian Janikowski, Tuesday, December the 8th, 2020. And what a long year it's been. It seems like we've gone through multiple cycles of ups and downs with the COVID, of course, and the economy and the markets and every other challenge which has been thrown our way. Anyway, this is our final webinar of the year, and it's nice to hear everybody. And there'll be plenty of chance for Q&A along the way. You can either use the chat, or there should be a Q&A section going on in the on your panel. So we'll leave enough time for those as well. So really, will 2021 be better? I'll answer that. So if those of you who are busy, here's the answer. Yes, things will be better. The market will certainly be better, even though it's done pretty well from its lows. The economy will undoubtedly be better, and quite a lot better given the lows that it hit. And I think we're likely to benefit from an economic stimulus, the last one of which was back in March, April. And so we've been rather bereft of any fiscal stimulus since then, and really relying on monetary stimulus and everything else to work through the system. So we will get all of those. And I think with that, I can confidently say that 2021 will be a better year. Let me try and advance the slides now. So let me try and summarize it. The labor market is the one which is in the biggest difficulty right now. It's slow to recover. Obviously, it took a huge hit in April and March, where we lost about 22 million jobs. Since then, we've recovered about 12 million of those. So there's sort of 8 million to go, but about 4 million people have exited from the workforce. That's kind of a theme which we saw for many years after the GFC. More and more people sort of not coming into the workforce for various reasons. Couldn't find a job, weren't qualified, weren't in the right place, couldn't relocate, had the wrong set of skills, or home pressures. And that's kind of happened again this time. So we're still sort of 4 million jobs below where we could be. If you include the people who've left the workforce, then we're about 8 million to go, and things have slowed a little bit. But the third wave obviously hasn't helped, and we're in the middle of that one right now, and it's probably got a few more weeks to ride. Look, everything depends on the virus, but the vaccine is a game changer. And everything you've read about the vaccines, and there seem to be at least 3 or 4 which are very close to FDA approval. Indeed, one, I think the Pfizer one, or maybe the AstraZeneca one, went public in the UK, and they're not usually ones to rush approval of a vaccine. So it's coming here. In fact, I heard on the radio this morning that there will be, there's some allocations already being made to various counties around San Francisco. So it's here. It is a game changer. Yeah, sure, we don't know the long-term effects of the vaccine, but what the little that I've looked at it seem that it have a very good efficacy rate, and it works pretty quickly even without the second booster. The Fed has really been the major game in town. I think at the end of the year, we shall raise our glasses to Mr. Powell and his colleagues, because they moved incredibly fast, as we all know, back in March, April, to make sure that there was no elongation of good monetary response to what was a economic catastrophe. The financial conditions are good right now. There's no real reason for them to put out more QE out there, or more purchases of other types of securities, or to signal any other kind of change in policy. There is a Fed meeting next week. We don't really expect them to do very much, because the financial conditions are pretty easy right now, and they know that the fiscal stimulus moves faster. Look, monetary policy, rule of thumb, usually takes about a year to work its way through the economy. You can have an immediate effect on things like valuations and mortgages, but in terms of lowering borrowing and having people respond to lower borrowing costs, it takes much longer than fiscal policy. They know that. And so that's why you've heard a kind of relentless drumbeat from Powell and his colleagues every time they're up in front of Congress, every time they're asked in public, that the fiscal response will be faster, and the sooner it comes, the better. But they'll continue to support the market, and I think do so in a very good way. The Congress, the talks are good. Of course, I'm not privy to these, but we've kind of gone from this 500 billion low ball to the 2 trillion high level number. They seem to be settling in around about 908. That's all not net new money. It's about 500 of that, which came from money not used in the CARES Act recovery. In fact, that was the money that was, brought yanked back from the Federal Reserve a couple of weeks ago by Treasury Secretary Mnuchin. So, but that's still money which has been unspent. It was meant to be for market support programs. I won't go into whether the Treasury should have done that with the Fed, probably not. But anyway, the money is back in the pot for other kind of stimulus package. So that plus the original McConnell base number, should lead to a number about 908. But obviously, we look every day, and we're not kind of sure when that's coming. I would say though that we're going to get something in 2021, early 2021, and if it's 500, that's about 2% of GDP, and if it's bigger than that, then that's still going to provide a fairly good bounce to the market. The economic stats, they'll all be better by Q2, and they'll probably start getting better in Q1. But right now, we're in the kind of trough of the third wave, and this winter is going to be tough. Whether it's things like retail sales or housing or manufacturing, and certainly employment are all going to be sort of tested, I think, for the next 6 weeks or so. But the rebound will be quick. This is, remember, we've talked about this before, this is not a recession caused by a financial shock. Nearly every other major standard recession, something that I can think of, going back 100 years, is normally caused by some sort of excess in the market, whether it's borrowing for housing in 2008 or tech stocks and people borrowing to be in the market in 1999. All the way you go back there, there's usually some sort of asset price bubble or financial condition meltdown, which leads to a recession. And this is not the case here. So that's why it fell so quickly, but it also means that it's likely to come back much more quickly than prior recessions, because there hasn't been a lot of destruction of capacity and manufacturing and industries. Again, we keep on coming back to the labor market being the very weak link here. There is, we talked about this before, it's very, very important this, the consumer savings have absolutely skyrocketed. So we're seeing this in the thrift and savings, and also in the M2 money supply. That's a bit esoteric, but basically that's cash available for spending. And those have really gone up to a level, I'll show you in a chart in a minute, which is unprecedented. So there's excess cash that consumers have. They've saved any kind of benefits which they might have been entitled to if they weren't unemployed. And spending has been cut way back, partly because of thrift concerns, but also because of less opportunity to spend money in the way that we used to. So there's a lot of excess cash in the system, and there's very low debt. We just saw another round of the consumer debt numbers, although people are taking out mortgages, fairly prudent rates, fairly prudent levels too. The consumer debt is really not accelerating at all, whether it's for credit card debt or auto loans or any other kind of fixed term loans. So the consumer is not burdened with a high level of debt on their savings, which is certainly what we saw in 2008. The headline employment will sound good. We saw a downtick last week, the unemployment rate from 6.9 to 6.7. I'd say don't pay too much attention to those. Those are more there for bragging rights. The Fed has made it very clear. Sorry, the Department of Labor, BLS, have made it very clear that those numbers are probably understated. What you want to look for is the U6 unemployment, which is about 12%. That's much better read of how much slack there is in the employment economy. And the numbers now are distorted by people answering the surveys wrong or moving from one type of unemployment benefit program to another. If they've run out of their 26 weeks of state unemployment benefits, they're moving over to the PUA program. Talk about this in our weekly blog quite a lot. And so they're not being caught necessarily as being unemployed, or they misidentify themselves as being unemployed. So the headline number will sound better than it actually is. There's still a lot of slack in the labor market. I think risk assets will continue to do well. We thought they were going to do well post-election. They have, and I think that's just it comes back to the stimulus expectations. Certainly the vaccine news helped a lot. Also just the level of uncertainty dropped quite a bit. So I think they're going to continue to do well in 2021. We said that post-election concerns will probably not materialize. That was a bit of a wing and a prayer, but it has been the case. And there's been, the markets are not paying a heck of a lot of attention to the various court cases and suits and arguments with the electoral rolls and commissioners in the various states. We could all get surprised by something weird going up to the Supreme Court, but at the moment that doesn't seem to be that likely, and certainly the market's not paying a lot of attention to it. Okay. Just a kind of reminder of, these are different drawdowns that we've had. So from peak to trough. So 2007, 2009 was a big one. So was the one before it, down 45% and 54%. And this time it was down about 33%. But that snapback a year later is on average about 22%. And we've had 62% since the bottom in March 23rd, 2020. So obviously, I think, the 3 years later on the other column, the 5 years later, obviously going to be, positive. That 62% number, obviously, bigger than all of those there, but that comes back to the fact that this recession was caused not by a financial condition, not by the Fed ratcheting up rates and trying to halt the economy from overheating. It was all to do with a kind of a withdrawal of labor through the close down. So again, I'll make this point because I think it's very important, is that we kind of see ourselves in these terrible economic numbers where the historical numbers look pretty bad by historical methods, but it happened quickly, and the snapback will happen quickly as well, and it's already shown up in the stock market. So look, the cavalry is on its way. This is Margaret Keenan. You won't know her, but she's in the UK, and she got the first vaccine jab, I think this morning or yesterday. And so this is, being rolled out. This, I think in the UK, they're sort of obviously trying to vaccinate the kind of triage of people who are most exposed. So elderly, frontline workers, so on, those with, other types of conditions, the kind of, the triage you would expect when it comes to, vaccination, where there's for now somewhat of a limited supply. But this is coming. I don't know when it's going to come to the US, but this is real. And I think, is a very, been an important part of why the market has done well over the last few weeks. I have a few problems seeing my screen on top of all the other stuff that's floating around. But just apologize if I'm not quick off the mark on these. But so there you can see the US, definitely had its third wave. I didn't see my mouse here, but here we go. This is the 7-day rolling averages of cases per 100,000. So we had 20 initially back, with the first wave. Obviously, a lot of this was in the Northeast. And here's the second wave, which happened in the early fall and summer. And then this is the third wave, which is kind of underway right now. So yeah, the US is clearly leading here. These other countries, I think, snapped down a little bit more severely. They've also got, much more unified healthcare systems and so on. So these can roll down pretty quickly. But the US is probably gonna, I'm not really gonna talk about the COVID tracking data very much, because I don't know, other than we all know that it's over 200,000 and hospital beds are in short supply. But I think that the general consensus is we'll start to roll off a little bit. But we're right in the middle of this third wave, which is why the economic numbers are going to look pretty poor for the next few weeks. We also bring up this one up because these are the states which really didn't have much to worry about for most of the COVID period. And then we, depending on your point of view, it just eventually kind of got to them, or that super spreader event, which we talked about last time, in Sturgis in South Dakota began to hit these states, and they were very ill prepared for it. But they too have come down. Now the graph is, these are relatively smaller states. It's got the two Dakotas here on showing up, but Nebraska, Wyoming, and Wisconsin is obviously pretty big. But again, that seems to be, in a better place than it was just a few weeks ago. So that's a good sign too. Some of these slides you'll recognize from the prior talks, because really this is a kind of continuation of a theme which we've been seeing since the summer, and it's all kind of incrementally helping the situation. So here's the Fed. The growth of the balance sheet has definitely tapered. They're not, even though they're buying about $80 billion of treasuries a month, that's going to continue. Another $40 billion of mortgage-backed securities. They haven't increased that rate, and we don't really expect them to. So the level of annual change here has sort of been relatively flat, but that's good. They're continuing to buy at those rates, plus they're reinvesting all the coupons that come out of these bonds. But for now, they'll resume if they have to at a higher rate, but they're continuing to support the bond market fairly aggressively. This, I think, is actually our flip to this one is, and it's a bit messier, this one, but this is the two curves down here shows what the Treasury yield curve is. So this basically measures what you might have to pay for 1 month money, which right now is about 12 basis points, all the way out to 30-year money, which is right now about 1.68%. These are just the changes since July, and these are pretty small. As you can see, the front end of the curve, what we call 1 month to 3 years, is basically unchanged. The Fed, this is mostly where the government borrows its debt from. They tend to sort of borrow in the Treasury market. About 60–70% of all the net borrowings are in 3 years or below. So there's much more of those than there are longer term bonds. So those really haven't changed, and the Fed can control the short term rates through the Fed funds rate, very, very, very closely. The long term rates have ticked up a little bit, and I think that's first we've got to remember ourselves where we are on the graph. The 10-year was at 68 basis points. That was a kind of a seasonal low. It's gone up to 92, which sounds a lot, but these, there's, I don't think it's implying that the Fed is going to tighten, that the economy is about to take off, or that inflation is, getting anywhere near the Fed's targets. This is just more of a little bit better optimism. We saw equities go up, and then bonds yields go up at the same time. There's in a good market, that's what you want to see. You want to see equities rise and bond yields tick up, because it usually shows that there's a demand for credit. But really, this is pretty much unchanged. It looks a little bit more dramatic. What we don't want is, this is what we almost had last year, or 2018. This is this up at the top here. Hopefully we'll never see that again in our lifetime, but this is where you have an inverted yield curve. And that's really bad news. We had a little bit down here as well in July 2019, where people thought that the various trade tariffs were going to create a recession, or at least a slowdown. But anyway, so we're in a nice positive yield curve. This black one is really what you want to see, it's where it's kind of nice and steep, and that's one from 2018. But this is where we are right now, and I'd say this is what the Fed's going to continue to look at and manage to. Again, when the Fed came out in August, they mentioned that they wouldn't be adjusting rates unless they saw unemployment at about 4.1%. Seems a strange number to pick, but that's what the consensus was. You take the averages of all the 12 voting members plus the other Federal Reserve chiefs, they all came out with a number which averaged to 4.1%. It was what they thought was the long-term natural rate of unemployment. And then the 2% inflation rate. You can see that, going back to 1954, you've only had 4 occasions where you've been below 4% unemployment and above 2% on the CPI. So we're so far away from that. Inflation ticked down a lot, as you'd expect it to, in the summer and post the immediate waves of COVID, and of course the unemployment number we've already talked about. So even if you just take the headline one, which I think is very understated, there's a very big gap between these two numbers. So every time the Fed, every time any one of the Fed speakers comes on, they talk about, they're asked about raising interest rates. They tend to come back to this and say, no, we don't see any reason to do it. So, and even recently when they've been asked about yield curve control, which is about them buying bonds further out on the curve, which would have an effect on the bond market, slightly negative effect, they've really come back to this and said, no, we don't see any reason to change rates, certainly on the upside. And there we have it. I mean, the number to look here is the black number. So that's 0.93% on the 10-year as of today. And It's certainly risen up from the lows of about 55, 60 basis points in midsummer, but I'd say look at the range. We're really kind of back where we were at the beginning of the pandemic. You know, a lot of this is kind of trading noise, and again, I don't think really indicative of any kind of major trend in the bond market, which we expect you know, yields to remain low. The deficit, you know, I grew up when there was sort of the horror of the twin deficits was used as a stick to beat the market nearly every day. That goes back to the 80s, and it was the current account deficit actually, which was the trade deficit plus services plus some other invisibles, plus the budget deficit. So it definitely has taken a hit, but it was also already on a bad trend given the tax cuts at the beginning of 2018, which I won't go over those again, except they were exceedingly ill-timed and ill-judged, but and it had almost no effect on economic growth. But here we are at the budget deficits at about 9.7. I would say this is one of the least things to worry about, partly because number one, you know, worrying about the budget deficit right now when the economy is so weak is really, you know, putting the cart before the horse and really not getting the priorities right. The budget deficit can be financed, can be sustained, can be managed. We really need to get the economy going. So that's the first reason. Second reason, of course, is that interest rates are incredibly low. So, you know, why not borrow long term when you can borrow at about at least 1% below the inflation rate? So you've got negative real rates of interest, and interest payments as a percentage of GDP by the federal government, I think is one of the lowest I've ever seen. So even though the deficit is, depending on which measure you use, we like to use the one which is used by the public as opposed to total deficit, some of which is held by the Social Security accounts. It's about $21 trillion, but the percentage, the rates on those are incredibly low. So it's really not a big line item on the government budget every week, month when they have to pay interest on it. So I don't think that's a source of worry. And I'd be more worried about this now. You know, if people see a direct line between the budget deficit and interest rates, then you just got to point to Japan and say, well, here's their budget deficit, which started out at about, you know, 80% of GDP and is now 245% of GDP, and interest rates went down from about 8% to zero, and they've been zero to negative for most of the last decade. Now, we're not even anywhere near this number. We're at about 100%, which you might say, oh, well, you know, 100% is still pretty high, but it's way down here. So what you don't want to have enough is this, because this is really, you know, an economy which is well, the employment is shrinking in Japan. Sorry, the population is shrinking in Japan. They've had incredibly low rates, interest rates, and really they've been, you know, trying to prime the pump to get the economy going for some years now. They haven't been able to do it. The US doesn't have the kind of demographic problems that Japan does, at least not yet. Probably not going to have it in my lifetime. So I'd be more worried about a situation like this where, you know, rates just stayed low because they just can't put enough fuel into the economy. That's certainly not the American problem. Now, flipping over to the labor market, you know, it's been a slow climb back. As I mentioned, you know, the claims we lost 22 million jobs in the space of 2 months on the payroll numbers. These are the claims. They don't add up because the people come in out of the claims numbers, and people might have multiple claims because they claim once, go back to work, claim again. But anyway, you can see the trend, and I apologize for the log scale. So we saw this 6.8 million. Yeah, remember the record before that? The record month of claims were about tied. One was in 2007, one was in 1981, where the labor force was quite a lot smaller, but those numbers were under 700,000. So these numbers like 6.8, 6.5, all the way down to here, which is where we are now. You can see things have leveled out a bit. Now these numbers are still pretty bad. And I think this has been part of the third wave story, that we haven't seen much improvement really in these numbers since for the last couple of months. And these are still very, very high by historical standards. So there's going to be a low climb back to get the labor market where it is. This is another one. So again, I had to break these up because otherwise the graph looked ridiculous. But here's the 22 million. And if you add all these up, you get about 12 million. You can see that 245,000 jobs. People are expecting more like 600,000. I think December is going to be a weak number too. The payroll survey for December, which will be published on January the 2nd or something like that. The survey week is next week. And we know from various other kind of data that the employment numbers haven't really ticked up very much. So we're going to see another month of pretty weak payroll numbers. I mean, there's one silver lining in there, that it should get the Senate and Congress and whoever's in charge of the White House a little bit more concerned that, you know, the unemployment number is not going to budge very much, and we're not kind of creating jobs at the level we should be. I think this will begin to turn around quite a bit, you know, in the end of the first quarter, the second quarter. But for now, it's one of the big issues. Here's the 12% unemployment rate I was talking about earlier. This is the headline one. That one I think is understated by quite a bit. This is really what I would look at in terms of capacity for the market to grow. So you've kind of got, you know, a lot more people who could enter the labor market. I took a snapshot of this, of just the ratio of employed people to unemployed. And so this, you know, basically the way to read this is, you know, up at the peak here, we had about 28 people employed for every one person unemployed. And it went down to, you know, 6 in no time at all. But it's doubled now, and you know, it's about 14. And you can see that that's way below the average, but, you know, it's sort of heading into the right direction. And not to be too brutal about it, but GDP is decided by the number of people in employment, not in unemployment. So as this number gets better, we'll start to see the GDP numbers improve. So again, this is you know, low by historical standards, but a pretty decent V shape, probably the best one here. So that's encouraging. The GDP numbers, again, pretty horrendous. Down 5 in the second quarter, down 31 in the second, down 5% in the first quarter, down 31%. Ridiculous numbers. These are annualized. Remember, these are not, it doesn't mean that the economy fell 30%. It's just annualized. So roughly it equates to about 5% reduction in GDP. But we've made some of that back with this 33% increase right here. And the latest numbers should show about a 4% to 5% increase in the fourth quarter. But now you look at other countries like Japan, a lot of Europe, it's the worst recession they've ever had. But actually this doesn't even, is it only in the top 8? I think I was looking at it earlier, there were much worse recessions. I mean, not that it's a heck of a lot of comfort perhaps, but the numbers there were worse numbers in 1920, 1932, 46, and so on. It's kind of a testament to the strength of the U.S. economy that you had one of these worst blows, and it still wasn't as bad as it had been in prior years, which means that I think, you know, the economy coming back pretty quickly is again likely to happen. So overseas they've had a bigger hit, one of the record hits to GDP. Here it's bad, but it's not a record one. And again, it happens so quickly that I think some of the snapback is going to be equally quick. Kind of coming off the last slide, you know, where are we in terms of expectations for the current quarter? Well, the Atlanta Fed puts out almost a weekly, daily, depending on what the economic data is, estimate of what the GDP is going to be. That's why it's called the GDP now. They literally say it's called GDP right now. And they've had a pretty good record. Back here, they've overstated it. You know, here they were thinking it would come out at 4% and the actual GDP was about 2%. They got this bit right. And right now they think it's about 11%. I think they'll shave that down a bit because they take it off data which they see, you know, which comes up every week. And some of the most recent data is probably like to show a downturn. But still, if it's not 11%, it'll be more like, you know, 7 or 8%, which is again not going to get us back to where we were. But this is a fairly good sign about the economy again coming back more quickly than a lot of people expect. I'm going to leave that one. And this is what I was referring to earlier about the personal savings side. Very, very important. The blue number is, shows about $2.3 trillion in savings. This is cash available through basically savings accounts at thrifts and banks. It's not hidden away in money market funds. It's not almost cash like treasury securities. It's pure cash, and that means that people can access it very, very quickly and go on spending once they feel confident about it. So that is unprecedented. We've never seen it as a percentage. As a percentage of GDP, I haven't shown that number here, but it's the highest it's ever been by a very, very long way. And also, as a percentage of monthly retail sales, for example, it's also, way ahead of any number it's ever been. Short answer, people, if they had unemployment benefits, they tended to save them, especially the supplemental ones that were available to them. And if you're in work, people generally, saved as much as they could if they were a little bit fearful about job losses, or indeed because they didn't have the same opportunities to spend in the same way as they do. We all know what's happened in the service-related economies. And this is the savings rate, 13.6. It spiked at nearly 30%. There's a couple of misleading articles I've come across which says that people are drawing down their savings. They're absolutely not. You don't draw down your savings unless this number, this yellow line goes below zero. Then that's when people are literally spending more than they're earning. But as long as that savings rate is positive, it means that people are, taking a certain amount of their wages, income, and saving it. Now, sometimes it's as low as 5%, but right now it's about 13% down from its peak. But again, people are still adding to this level of overall savings in the economy. So, why is it important? Again, because along with the fact that there's very low consumer debt, it means that people can come back very quickly to spending if they feel confident about it, and they will eventually. That's the same. It's the same story basically. So let's just take to the November high frequency data, where the ones we looked at last time. I've updated these. So here we are in December 2020. There's an interesting chart up here, which is the Federal Reserve put together a mobility index. Basically, this was them measuring, how people move around, and they got it from Apple and Google, but it's a combination of the number of devices that leave their home every day, or that they're, that they stay, more than 3 hours away from their home, or they travel more than about 5 miles away from their home. So basically, in a lockdown, no one's moving. And so, there's very little activity going on here. And this shows the change from January 2020. So if we sat here back in April, people essentially had ceased to move. There's almost a 100% decline in mobility. And then it began to tick up, and it's holding up here, which is good. So now it's around about, depending on the state and the US, it's around about 40% below what it was in January. So that's a lot better than what we saw in the early spring. It's taken a bit of a dip down recently. That's probably because you've seen some of these states, especially Texas, which is the one that counts because it's a much bigger state than the other two here. Putting a little bit more curbs on movement, either putting in requirements that people not move, or people just voluntarily saying, I don't want to move because it's going to put me in danger. I mean, in the US, in Texas, for example, Fort Hood, Texas, outside of Austin, has about 150,000 people there. And that's just the military personnel. So they're the federal government, and they're the army that muck about with this stuff. So they've actually put huge restrictions on mobility. So you'd expect those to come down quite a little bit, but they're certainly a lot better than they were. This is the TSA checkpoints. Again, we've seen this kind of gradual increase. There's that little spike ahead of Thanksgiving, then it's come down a little bit, but again, they're kind of trending higher. I mean, not dramatically higher, but better. And then the last one is from Open Table. So this is the restaurant bookings. So that's not a mistake. They obviously went to zero. Nearly all these major states closed down restaurants. they've begun to pick up, and then we've seen this upturn and then this decline recently again. But I think these are, obviously we've got new mandates here in California. I think people are going to stay put for a while, but then eventually they'll, come back, and it's not going to go down to the same level it was before. I've also mentioned that, the pandemic has really hurt lower paid people much more than people with good salaries, good incomes. I mean, if you were in something like bartending or cleaning or home hotel service work, typically a lot of people that work 22 hours a week, not by choice, because that's the way employers avoid having to pay them benefits. A lot of those people lost their jobs, but they weren't as big as spenders as the people who retained their jobs. So there's been this, ongoing almost boom in people wanting to buy trucks and cars. We mentioned this before. That's something which you feel confident about, and you feel you can get a loan, and you feel that you can afford that type of expenditure, then you can do it pretty quickly, and that's snapped back very well. And it's the same. And I think people, buying more cars, they might have delayed purchases of it because they don't want to take public transport, or they got more, they need to be more mobile. And it's the same thing with the US home sales, which, kind of went down briefly, but then just kind of roared right back, and we're at a level which we haven't seen since 2007. Now, part of that is the millennial that won't go to demographics today, but there is this millennial, the 25, 35-year-olds who are, a bigger cohort than the boomers, because the boomers are dying. But this is a lot of these people postponed household formation, families, all those things, because they came out of college in 2008, and it wasn't a particularly good time to hit the workforce. So they've delayed a lot of these purchases, but now I think they're sort of beginning to think about, coming back to buying houses. So there's a sort of demographic boom behind housing. A lot of people also moving out of the city. Low mortgage rates makes it attractive to buy houses and start moving around. And of course, down here is an indication of supply, but the supply has been very much constrained compared to prior years. So this number up here, it's only just now that the number of new home sales is coming down to the long-term average of the population growth. For all of this time up here, we weren't building enough houses, so there's been a lot of supply issues as well, to kind of keep people working on going out and buying houses. Okay, turning our attention to the stock market, I would like to remind myself of this, that the changes in prices can be very dramatic. Obviously, we saw this 35% decline in the S&P here. It's the black line, so going back to cast your mind back to March, where we saw precipitous change. But things like dividends and earnings per share were not nearly as volatile. And in percentage terms, we went from about $145 per share on the S&P to 120. Well, compare that to what happened in 2007, where we went from about 80, down to 40. And that's because all of the banks and all the guys that we thought were doing really well turned out to be have rather dodgy finances and accounting methodology. And so the downturn was very, very extreme in earnings. Here it's not. It's just certainly large parts of the S&P are very, very affected by the downturn in demand. And if you're someone like, a hotel chain or casinos, cruise ships, or essentially all of your earnings, sales went away, revenue went away. But if you take the S&P as a whole, the earnings decline has been pretty modest, considering we had this big decline in GDP. Again, why? Because this wasn't a recession initiated by a financial crash or high interest rates or any other sort of asset bubble. It was just a withdrawal of purchasing by the population lockdown. So I think that number is going to start, increasing pretty rapidly over 2021. Goldman Sachs guys seem to think it's going to be about $175, which is a heck of a big increase. But it might well be done because some of these cyclical companies don't need, think of an airline. it only needs to go from 40% load to 60% load, and they get, because of the marginal cost of carrying a passenger is very, very low, it hits their bottom line very, very quickly. And there's a lot of industries like that, which would come back very quickly. Dividends has been a bright spot. There were some, cuts in dividends, especially from the financial companies who were told to hold back on dividend distributions by the Fed, but some of those have been relaxed. So the dividend number has been very well supported. I just did a quick review this morning of companies that have increased their dividends over 1 year. It's about 80 in the S&P. Now, that doesn't make it sound like a lot, 80 out of 500, but remember, there's only about 350 companies in the S&P which pay dividends. There's plenty like, Facebook and Google's, and we all know who they are, don't pay dividends. They tend to, return the cash via share buybacks. But so it's pretty impressive, I think, that you've got, this is some financials in here, Comerica, Citizens, Northern Trust, and so on. Just going to reading along the x-axis here. But there's others as well where there's been some pretty robust dividend growth. So if you're a CFO, CEO, you don't increase dividends if you think you're going out of business, or you see much tougher times ahead. So I think this is a good sign that we're asked nearly on a daily basis, why is the stock market so high when everything I look around me looks so terrible? Is again, in addition to the normal answer, the S&P is not the economy. It doesn't look anything like it. You've also got things like this happening where companies are actually husbanding their resources and cash and feel that they can pay dividends to shareholders. Since we last talked also, we've seen a much better rally in a small and mid cap. It's very much a large cap led rally out of the gates. And the top 5, this is the Microsoft, Apple, Facebook, Google, Amazon gang. Great guys, 30% of the S&P. Obviously kind of roaring ahead. It's been a little bit flat over the last few months, but you can see that while they were sort of flat, the small and mid cap, this is the S&P 600 and the S&P 400 rallied a lot. So they rallied from 80 to, in the case of the S&P 600, 105. So what's that, a 22% increase while these guys were flat. So that's really good news, because if it was concentrated in the large cap tech, that's one thing. We could certainly make money from that. That was a good thing. Plenty of spillover effect. Work from home, cloud computing, all those kind of things, which are very important and very growthy. But you need to see the recovery spread out a little bit. And so we've seen that with the small and mid cap rallies, and we think they'll continue to run, especially into 2021. We've also seen, the cyclical plays. So I wouldn't talk about the industrials here because it's really a misnomer, but I will talk about the transportation index. So this is, FedEx, UPS, a couple of the railroads, CSX, I think, they'll move a lot of freight around. There's a J.B. Hunt, which is a trucking company, which you probably see on the highway a lot. And there's Kirby, which is a barge company, which if you live in the Midwest, you see that barges taking all sorts of produce up and down the major watery arteries. And there's also the airline stocks, which haven't recovered very well. But my point is that transportation is very, very cyclically sensitive. These are stocks which, are early plays. They fall early in a cycle, because their volume drops away quickly. They can't cut their costs quick enough, but they come back very quickly if they see upticks in volume. So the fact that the transportation index, which is, just normally doesn't get any respect from investors because it's full of these, kind of old world stocks, which are considered to be all X growth, has done really, really well. So again, from its low back in October, we're looking at, a 15-16% increase and outperforming the S&P. So that's good. With the small and mid and the early cycle players coming into the market, that means that we're talking much more about a broader market than just the tech guys. And the international too. And this is in dollar terms. So one of the themes has been dollar weakness for the last few months. I won't go into it other than we continue to think that the dollar will kind of gradually weaken over the next year or so. It's mostly to do with interest rate differential. But these markets, A black one is Japan. Japan's the stock market's at a, well, its record high was 140 back in 1989, and it won't touch that again. But it's high. It's its best in about 32 years. So Japan has not suffered from COVID on the health side, but it certainly suffered from an economic side, given its trading prowess and industries. But they've come back. The other line is the European stock markets, and the blue one is just a German index, which is a component of this European one. But the story is here. Look, there's quite a good snapback here. So again, when we come away from big tech, we've seen a broader market participation in the S&P. We've seen small and mid cap come up, and we've also seen these international markets come up. And there's another chart which I've got time for, which will also show it happening in emerging markets. So let's put all that together. Kind of where are we kind of going into the last stretch for the year? I think, you know, US large caps are going to stay in focus. The tech companies are just too big, too powerful. I'm not too concerned, this is a different story, but about the re-regulation or regulatory sort of overhang that these guys might have. Obviously, they're being coming out from two sides with the DOJ and, you know, various other kind of government investigations. I think if anything, they certainly showed it under Obama, but I don't think Biden is going to do the same thing, because he'll catch a lot of flack for it. But you know, under Obama, the tech companies could do no wrong. They just kind of continued to grow, and no one on the antitrust suit, you know, laid a finger on them. I don't think that's going to happen quite again, but I wouldn't be too concerned about the you know, the sort of antitrust push against tech. I think the fiscal side coming, vaccine here in some places, plus the Fed, you know, combined that, it's got a very strong growth coming on from especially 2020, second quarter of 2021 on. We just got to get through the next month or so. More and more sectors are coming into play. I think the tax reforms, we haven't heard much news about them, obviously, because we haven't had the clean sweep, which was an expectation last time we met. But I don't think they're going to have any effect on the market at all. The corporation tax, if it goes up a couple of points or two, it will make very little difference. There'll be some howling from certain quarters, but really the effective tax rate and the actual sort of regulatory or standardized tax rate are two very different things, and there's a differential of almost 15%. So I'm not concerned about that. I think tech IPOs, we've got a couple coming up, Airbnb, DoorDash. I don't pretend to know much about them, other than the tech IPOs have been going generally quite well. I think that helps sentiment, it helps the retail part of investing. And I think they're getting away, you know, into the market at quite solid stories behind them. M&A, very important. It's been very big this year. It's about 1.6 trillion now. The S&P is capitalized about 32 trillion. So that's about 3 or 4% of the S&P. Now, it's not all in the S&P, but that's still a very big number, and I think it's the biggest number we've seen in quite a while. And a lot of these bids are for cash. So you know, it'd be one thing if they were stock deals or heavily financed by debt. A lot of them are just, you know, trading for cash. And that means that not only does that help the kind of general story about, okay, which companies are next on the M&A side, and obviously saw some big ones last week with S&P and IHS, which is a data supplier. And also Salesforce and Slack, I think. But again, those are, you know, fairly big numbers. It means that the cash is coming back into the market. So if you're a shareholder of Slack, you're going to get your, you know, your money back, and you can either spend it maybe, or you'll probably reinvest it into the market, most likely. So that's going to happen on a very large scale. On the short-term risk, clearly, you know, it's all about how much gets closed and how much damage gets done in the next wave. I don't know if there's going to be a wave coming out of the whole Thanksgiving thing. People seem to think there is, but I think it's, you know, the weather related and the uptick we're having is going to be a short-term risk. Longer term risk is, you know, how long it takes for the labor force to recover. If it's like a post GFC, it'll be a long time, but I think it'll be quicker than that, just because, again, a lot of industries haven't been permanently damaged, which is what they were in 2007. I think we'll see the earnings rise by about 30% in 2021. I've already mentioned that. We're at about 130 $30, $40 on the S&P, put it up to about 160, 70. If you want to go with the Goldman Sachs estimates, they're at the top end of the range, but that puts the market on about a P of 20 to 21, which is expensive, but not dramatically so. And I think is somewhat justified by the growth and also the fact that interest rates and inflation is so low. The Fed for now is going to be on full ease mode, as is every other central bank in the world. So they're really not an issue right now, a source of worry. If anything, they'll intervene if they have to. But right now, they're pushing for fiscal response as loudly and as directly as they can possibly do. And I think that's what we're going to see, which will help the market into 2021. So. Well, look, thanks very much. It's kind of a race through on everything, but I know it's been a tough year for investors and everybody on lockdown. I've got a couple of questions here, which I want to make sure I cover. But we feel pretty confident about the market. I don't think there's any kind of major setback likely other than the kind of risks we've identified. We're kind of in a slow process where now the vaccine, I think, is going to help things a lot. And the markets, I think, are poised for a fairly good 2021. It's especially nice to see the fact that the market broadened out a lot over the last month or two. I mean, it's taking a rest now because November was so good. It meant a lot of portfolios ended up rebalancing. But I think for now we'll be in a sort of a fairly quiet period through the end of the year. Let's see if I can get the Q&A going. Yeah, I see the questions. I think I have to stop sharing to get them. Let me do that. So I don't know what you're looking at right now. Here we go. What has overall been the impact of the Trump tariff wars? What do you predict on the longer term effect going into 2021, 22? I think the tariff wars have just been, annoying, irritating more than anything else. The big issue, I think, in 2019 was that every Friday you had some sort of, bellicose call coming from the White House or Leitzinger or one of those tariff trade guys, talking about how they were going to win the war against China. Everybody expected that, the tariffs coming into the US would end up being paid for by consumers. They were. Import taxes went up. They went up from about 20 billion to 70 billion. So, a tax is a collection of revenue. Who pays it? The people who are importing the goods. So the initial effect was deflationary and sort of anti-growth. Now they've had very little impact. I mean, the trade numbers came out on Friday. They were higher than they were. 67 billion, something like that. They were about 50 billion when Trump started all this stuff. So they've had no effect on the trade balance at all. That makes sense because, if you've got a consumer recovery, which is what we've had, the US buy a lot of consumer goods, which are made in China, starting with your cell phone and, electronic goods, household goods, and so on. We tend to export more capital items, and we're not in a period right now where people are buying a lot of capital expenditure. And we also do well on services trade. So that's can be vacations and airlines and, everything from legal and accounting service, asset management service, all these things which are invisibles, which show up on the total trade, but not on the trade for goods. I think my guess is that Biden's not going to just kind of go back to pre-Trump days. I think there'll be a bit more of a negotiations both with the EU and China. But if I was in a large company exporting stuff, or in a company dependent on a lot of imports, I'd be bringing a lot more sigh of relief going into 21, 22 than I was earlier this year, where you just really didn't know what the hell they were trying to do. Seeing as you're no stranger to the robust recovery that happens after downfalls, what additional moves might you make to prepare for the coming uptick? One of the things that we're probably going to be doing is moving a little bit out of treasuries. More to come on that, because we think they're kind of sideways, and we feel that they've really done a great job for us in protecting us against some downside, but they're probably going to stay at this level for a while. We also might cut a little bit back on our value exposure, which we do have, just because they've done well so recently, and continue to sort of build up our growth allocation. So there's probably the two major things. We've got enough international and emerging markets and small company; those have done well. So we won't be increasing on those, but we'll continue to do those. What are you asking Santa to bring you for Christmas? Just a respite from the tweet storms that we all have to, subjugate ourselves to on a daily basis would be awfully nice. I hope a certain somebody goes to Florida and stays there. Could you comment on US competitive globally and how that might affect US growth and economic health? I think the US is very competitive economy. I mean, productivity growth has slowed a little bit in the US, but that's partly a factor that we have more services in the economy than countries which are still on an earlier path of deindustrialization. I think our biggest competitive assets are the size of our domestic market. I mean, that's the reason I think that the global tech companies are all US dominated. They can get to a couple of 100 million consumers, and no other country other than China can come close to that. So I think our competitiveness is pretty good. The dollar weakness will help a little bit on that, but we've also got a very fluid labor market, which I think makes us fairly competitive. So I think if I was not US based and worried about US liabilities and therefore had to think about US assets all the time, I'd still have a very large part of my global portfolio in the US. I just think companies' abilities to innovate here are unparalleled. So obviously we like that. Thank you. Looks like we have no open questions. Thanks so much for staying with us. If you have any email or questions or follow-ups, please share them with us. Cthwaits1 at Brown Jankowski. You're very welcome. Thank you, that person. If any other questions, please talk to your wealth advisor. We're happy to answer anything we can, and wish you all a very happy rest of December and New Year, and look forward to catching up with you again soon. Thank you.